Well, let me tell you something. You spend 40 years doing the right things. You save. You contribute to the 401k. You diversify like they told you. You watch those statements grow month after month, year after year. And somewhere along the way, you start believing in the plan. You start seeing that number. Maybe it is 800,000. Maybe it is 1,200,000. Maybe it is 650. And you do the math in your head. You think, okay, if I pull 4%, that is 32,000 a year plus Social Security, and we can make it work. We can travel a little, help the grandkids, live with some dignity. And then you retire, you leave the job, you sign the papers, you get the cake and the handshake, and you walk out the door. And 2 months later, the market drops 10%, then 12. Then you open the statement and $50,000 is just gone, vanished. Not because you did anything wrong, not because you made a bad bet, but because the timing, you see, the timing was just wrong. And now you are sitting there at the kitchen table with your spouse, and you are looking at each other, and you are asking the question nobody wants to ask. What if we run out? I have seen this movie before, you know. I have watched it in 2001, in 2008, in 2020, and now again in 2025. And every time it is the same people who get hurt the most. The ones who cannot wait it out. The ones who do not have 10 years to recover. The retirees. The folks who did everything right and got caught in the machine anyway. And they say things like, we are losing everything. And the terrible part is sometimes they are not wrong. Because here is what most people do not understand about retirement. It is not just about how much you have when you stop working. It is about when the losses happen. You can lose 30% of your portfolio when you are 45. And if you do not panic, if you keep working and keep saving, you will be fine. The market comes back. It always has. But if you lose 30% at 66, right after you retire, right when you start taking money out every month to pay the mortgage and the prescriptions and the groceries, well, that is a different story. That is what we call sequence of returns risk. And it can destroy you. So that is what we are talking about today. Not some abstract market theory, not some academic exercise. We are talking about real people, millions of them, who are watching their life savings shrink in real time and wondering if they made a terrible mistake. We are talking about a retirement system that was built for a bull market, stress tested in a bear market, and found badly wanting. And we are talking about what I have been watching, what I have been positioning for, and what I think you need to understand if you are anywhere near retirement or if you care about someone who is. Now, let me be clear about what this is and what it is not. This is not another one of those stories where someone loses money on meme stocks or crypto or some speculative nonsense and then acts surprised. This is not about people taking crazy risks and getting burned. This is about something much more fundamental and much more frightening. This is about the retirement system itself, the one that millions of Americans depend on, being stress tested under conditions it was never really designed to handle. You see, the whole structure, the 401k system, the target date funds, the 4% withdrawal rule, all of it was built and optimized during the longest bull market in American history. From 1982 to today, with a few interruptions, we have had 4 decades of generally rising prices. And during that time, an entire industry grew up selling people on the idea that if you just saved enough, diversified properly, and stayed the course, everything would work out. And for a lot of people, it did. But that does not mean the system is sound. It just means the system has not been truly tested yet. What we are seeing now in 2025 is the beginning of that test. And I will tell you, I do not like what I am seeing. The math is brutal. If you retire at the peak of a market cycle and the market drops 20 or 30% in your first 2 years of retirement, and you are pulling out 4 or 5% a year to live on, you are selling stocks at the worst possible time. You are locking in losses. You are shrinking the base that has to recover. And even if the market does come back, even if it goes on to new highs 10 years later, you might never catch up because you sold when you should have been holding, but you had no choice because you needed to eat. This is what the finance professors call sequence of returns risk, and it is the thing that destroys retirements. It is not the average return over 30 years that matters. It is the order in which those returns happen. Two people can have the exact same average return over 3 decades, and one of them can run out of money while the other dies with $2 million in the bank, all because of when the bad years hit. Now, why does this matter right now in November of 2025? Because the market, by almost every measure I look at, is expensive. Not just a little expensive, historically expensive, the kind of expensive that has in the past led to long periods of poor returns. And if you are 62 years old and thinking about retiring, or if you are 68 and you just retired 2 years ago, you need to understand that the odds are not in your favor right now. The setup is bad. The valuation is stretched, and the room for error is very, very small. So this is not some theoretical conversation. This is not me talking about whether the S&P goes up 5% or down 5% next quarter. This is about whether people who work their entire lives can afford their medicine, whether they can keep the house, whether they outlive their money. That is what is at stake. And anybody who tells you this is just normal volatility, anybody who says do not worry, it always comes back. Well, they are not wrong, but they are not answering the right question. The question is not whether the market comes back. The question is whether you can afford to wait. So let us talk about where we are. Let us talk about what the numbers are actually saying, because if you understand the setup, you understand why so many people are in trouble right now. And I want to be very precise here, because this is not about predicting the future. I do not predict. I position. But I do pay attention to valuation, and valuation tells you something important. It does not tell you what is going to happen next week or next month, but it tells you what kind of returns you can reasonably expect over the next 7, 10, 15 years. There is a metric that people sometimes call the Buffett indicator. I did not name it, but I will explain it. It is the total market capitalization of all publicly traded stocks divided by gross domestic product. It is a rough measure of whether the stock market is cheap or expensive relative to the size of the economy. And right now, as of late 2025, that ratio is sitting above 200%. To put that in perspective, it was around 70% in the early 1980s. It hit 137% right before the dot-com crash in 2000. It briefly spiked to 196% in early 2021 before pulling back, and now it is back above 200. Now, does that mean the market's going to crash tomorrow? No, it does not work that way. Markets can stay expensive for years. They can get more expensive. But what history tells us is that when you buy stocks at these levels, your forward returns over the next decade tend to be very poor, sometimes negative after inflation. That is just math. If you pay $200 for every $100 of economic output, you need that output to grow very fast, or you need valuations to go even higher, or you are going to be disappointed. There is another measure, the cyclically adjusted price to earnings ratio, the CAPE ratio. It smooths out earnings over 10 years to avoid getting fooled by temporary spikes or crashes in profits. And right now, it is above 39. The long-term average is around 16 or 17. The only times it has been meaningfully higher than where it is today were 1929, right before the Great Depression, and late 1999, right before the dot-com bubble popped. Again, that does not mean we are about to have a depression. But it does mean we are in rare territory, and historically, rare territory has not been kind to people who need their money in the next 5 or 10 years. Now, I have been watching this for a long time, I have been managing money for more than 60 years. And I can tell you, there are times when you look around and you see bargains everywhere. Stocks trading at 8 times earnings, good companies selling for less than the cash on their balance sheet, businesses you understand with strong competitive positions available at prices that make no sense. Those are the times when you should be aggressive. Those are the times when you back up the truck. And then there are times when everything is expensive. When people are paying 50 times earnings for companies that might not be around in 10 years. When speculative garbage is going up every day just because it went up yesterday. When the cab driver and the shoe shine boy are giving you stock tips. Those are the times when you should be cautious. those are the times when you should be holding cash, waiting for the next opportunity. And let me tell you where we are today. Berkshire Hathaway, the company I have run since 1965, is sitting on $382 billion in cash and short-term treasury bills. That is not because I think cash is a great investment. It is not. It earns almost nothing after inflation. It is because I cannot find anything worth buying at current prices. In 2024 alone, we sold $134 billion more in stocks than we bought. We have been a net seller for 9 consecutive quarters. That is not a market timing call. That is a valuation call. When the opportunities are not there, you do not force it. Now, here is the thing that worries me. The individual investors, the retirees, the people in target date funds, they do not have that option. They are told to stay fully invested. They are told not to try to time the market. And in general, that is good advice because most people are terrible at timing. They sell at the bottom and buy at the top. But there is a difference between timing and valuing. There is a difference between trying to guess what the market will do next month and recognizing that current prices imply very low future returns. And if you are 25 years old, that is okay. Low returns for the next 10 years just means you get to buy more shares at cheaper prices while you are still working. But if you are 65, if you just retired, if you are taking money out, well, low returns are not just disappointing, they are dangerous. They are the difference between independence and dependence, between dignity and desperation. And that is what nobody's talking about loudly enough. Now, I want to talk about what we have been doing at Berkshire because I think it tells you something about how I am thinking about risk right now. And I want to be careful here because what makes sense for Berkshire does not necessarily make sense for an individual investor, especially one in retirement. We have different time horizons, different liquidity needs, different tax situations, but the principles, the way of thinking about value and risk, those are universal. As I mentioned, we are sitting on $382 billion in cash and treasury bills. That is not a normal position for us. For most of my career, I have kept cash at relatively low levels, maybe 5 or 10% of our portfolio, because I wanted to be fully invested in good businesses at good prices. Cash is not an investment. It is a call option on future opportunities. And if there are no opportunities today, you hold the cash and you wait. But this is different. $382 billion is not 10%. It is a huge portion of our assets. And we got here by selling. In 2024, we sold $134 billion more stock than we bought. We have been a net seller for 9 straight quarters as of the third quarter of 2025. We sold more than half of our Apple position, which was our largest holding. We sold Bank of America shares. We have been pruning positions across the board. Why? Not because I think these are bad companies. Apple is a magnificent business. I have said that many times. But at a certain price, even a magnificent business is not a good investment. And when I look at the prices people are paying for stocks today, I see very little margin of safety. I see very little room for disappointment. And in investing, you want to buy when you have a big margin of safety, when the price is well below what the business is worth, so that even if you are wrong about a few things, you still do okay. Right now, that margin has disappeared. People are paying prices that assume everything will go right, that earnings will keep growing at high rates, that interest rates will stay low or come down, that we will not have a recession, that there will not be any geopolitical shocks or financial accidents. And maybe all of that will happen. But I have been around long enough to know that something always goes wrong eventually. And when it does, the people who paid peak prices get hurt. So we are holding cash. We are being patient. And yes, that cash is earning some return now. Short-term treasury bills are yielding around 4 to 5%. Which is better than it was a few years ago when rates were near zero. But even so, after taxes and inflation, it is not much. It is not going to make us rich, but it is not going to make us poor either. And more importantly, it preserves our ability to act when the time is right. You see, the great fortunes in investing are not made by being fully invested all the time. They are made by being patient, by waiting for the fat pitch, and then swinging hard when it comes. In 1974, when the market collapsed and everyone was panicking. We were buying in 2008 and 2009 when the financial system was on the brink. We bought Goldman Sachs preferred stock at 10%. We bought General Electric. We made deals that would never have been available in a normal market. But to do that, you have to have cash when everyone else needs it. You have to be liquid when liquidity is scarce. And that means you have to be willing to hold cash when it feels stupid, when everyone else is making money and you are sitting on the sidelines earning nothing. That is the hard part. That is the part most people cannot do. They get impatient, they get envious, they see their neighbor getting rich on some stock that has doubled, and they think, why am I not in that? And so they buy at the top. Now, like I said, what works for Berkshire does not necessarily work for a 70-year-old retiree. Berkshire has no liabilities. We do not have to make payroll for ourselves. We do not have to take required minimum distributions. We can wait 10 years if we have to. But a retiree cannot wait 10 years. They need income. They need to pay bills. They need liquidity. So the calculus is different, but the principle is the same. You do not want to be forced to sell stocks when they are down. You do not want to be in a position where you have to liquidate at the worst possible time just to meet your living expenses. And that means you need to have some cushion, some cash, some bonds, some stability. It means you cannot be 100% in stocks at age 65, no matter what the target date fund told you. And yet, that is exactly the position a lot of people are in right now. They followed the conventional advice. They stayed fully invested. They believed in the system. And now the system is testing them in ways they were not prepared for. Now let me explain the mechanics of why this is so dangerous for retirees. Because once you understand how the system actually works, you understand why timing is everything and why a bear market in your first few years of retirement can be catastrophic. When you are working and saving, market volatility is actually your friend. If stocks go down 30% while you are in your 40s or 50s, that is good for you. You keep getting your paycheck. You keep contributing to your 401k. And now you are buying shares at much lower prices. When the market recovers, and it always has, you end up with more shares than you would have had otherwise. You dollar cost average your way through the cycle. But the moment you retire, the math flips. Now you are not contributing anymore. You are withdrawing. And if the market goes down right after you retire, you have to sell shares to generate the cash you need to live on. You are doing the opposite of dollar cost averaging. You are selling low. And every share you sell at a loss is a share that cannot participate in the eventual recovery. Let me give you a simple example. Suppose you retire with $1 million. You plan to withdraw $40,000 a year, which is 4%, a number that financial planners have used for decades as a supposedly safe withdrawal rate. In your first year, you take out $40,000. You have $960,000 left. Then the market drops 20%. Now you have $768,000. But you still need $40,000 for year two. So now you are withdrawing more than 5% of your remaining balance just to maintain the same income. And if the market stays down or drops further, the math gets worse and worse. Meanwhile, someone who retired with the same $1 million, but 10 years later, after the market had already recovered and gone to new highs, they might start their retirement with $1 million in a rising market. They take out their $40,000, the market goes up 10%, and now they have $1,028,000. They are ahead, same withdrawal rate, same portfolio, completely different outcome, all because of when the bad returns happened. This is sequence of returns risk, and it is the most underappreciated danger in retirement planning. The average return over 30 years does not tell you anything about whether you will run out of money. What matters is the order of the returns. If you get the bad years early, you can be in serious trouble, even if the market does fine over the long term. Now, on top of that, you have required minimum distributions. Once you turn 73, the government forces you to take money out of your tax-deferred retirement accounts, whether you need it or not. They want their tax revenue, and if the market is down, well, too bad. You still have to sell. You still have to realize those losses. You do not get to wait for the recovery. And here is where it gets even uglier. Most people in retirement do not have a lot of flexibility. They cannot just cut their spending by 30% because the market is down. They have fixed costs, the mortgage or the rent, the property taxes, the insurance, the prescriptions, the utilities. Maybe they are helping a grandchild with college or dealing with a medical issue. These are not discretionary expenses. These are survival expenses. So what happens? They sell, they liquidate, they take the loss, and they do it at exactly the wrong time, not because they're dumb or panicky, but because they have no choice. The system is designed to force them to sell in a down market. And that is the part that nobody talks about when they are selling you on target date funds and automatic rebalancing and staying the course. They do not talk about what happens when you need the money and the money is not there. Now, the 4% rule, the one I mentioned earlier, that came from research in the 1990s looking at historical market returns. And the idea was that if you withdrew 4% of your starting balance in year one and then adjusted that dollar amount for inflation every year after, you would have a very high probability of not running out of money over a 30-year retirement. Based on history, it worked most of the time. But here is the problem. That research assumed a certain mix of stock and bond returns. It assumed that if stocks did poorly, bonds would do okay, and vice versa. It assumed a relatively normal valuation environment at the start of retirement, and it assumed you would not live longer than 30 years. Well, starting valuations today are not normal. They're extreme. Bond yields were near zero for years, so the cushion from bonds was much smaller than it used to be. And people are living longer, which means the money has to last longer. So the 4% rule, which was already just a guideline, not a guarantee, is probably optimistic for people retiring today at these valuations. Some researchers now say you should plan on 3%, maybe 3.5%, if you want the same level of confidence that you will not run out of money. But if you saved $1 million expecting to live on $40,000 a year, and now someone tells you that you should only take $30,000, well, that is a very different retirement. That is a different lifestyle. That is maybe not helping the grandkids. That is maybe not traveling. That is maybe cutting back on things you thought you had earned. And that is the betrayal that people are feeling right now. They did what they were told. They saved. They sacrificed. They believed the plan, and now the plan is breaking down, not because they did anything wrong, but because the market got too expensive and the timing got unlucky. So let us walk through what actually happened. Let us reconstruct the timeline, because when you see how this played out, you understand why so many retirees are frightened right now. We start in early April of 2025. The market had been running hot for months. The S&P 500 was near all-time highs. People were feeling good. Retirement accounts were looking healthy. And then, reportedly, the administration announced a new round of tariffs, broader and more aggressive than many people had expected. The market did not like that. Trade wars create uncertainty. Uncertainty kills investment. And investors started selling. Over 2 days in early April, the market dropped sharply. According to multiple reports, roughly $6 trillion in market value was wiped out in that 48-hour period. That is not a small correction. That is a crash. The S&P dropped about 10% peak to trough in just a few sessions. The NASDAQ, which is heavy on technology stocks, got hit even harder. Some individual stocks were down 15, 20% in a matter of days. Now, if you are a retiree and you are looking at your statement in mid-April and you see that your $800,000 portfolio is now $720,000, that is $80,000 gone, just gone. And you are thinking, well, maybe this is temporary. Maybe it will come back. And for a while, it did stabilize. The market bounced around. There were some recovery days. By summer, things had calmed down a bit. Some of the losses were recovered, though not all of them. But then we get to November, just a few weeks ago, and we see another wave of selling, this time concentrated in technology stocks. The NASDAQ fell sharply again. According to reports, another $1 trillion in value was erased in a single day in mid-November. And now you are back in panic mode. Now you are wondering, is this the start of something worse? Is this the big one? Should I get out? Should I go to cash? And here is where the behavioral part kicks in. Because when you are retired, when you do not have a paycheck coming in, when you cannot replace what you lose, your relationship to volatility changes. When you were working, a 10% drop was annoying but manageable. Now, a 10% drop feels like a threat to your survival because it might be. Fidelity reported that the average 401k balance dropped about 3% in the second quarter of 2025 due to market volatility. That does not sound like much, but if you are at or near retirement, 3% might be $15,000 or $20,000. And if it happens again in the third quarter and again in the fourth quarter, now you are down 10 or 12% for the year, and that starts to hurt. NBC News talked to retirees in April who said they were stunned watching their accounts shrink because of the tariff-related turmoil. One couple said their 401k dropped significantly in just days, and they felt helpless. They had no control. They had done everything right, and now external forces, trade policy, geopolitics, things completely beyond their influence were destroying their security. And yet, here is the paradoxical thing. Despite all that fear, despite the volatility, most people did not change their allocations. Fidelity also reported that only 5.5% of 401k participants made any changes to their investments during the second quarter, even as the market was gyrating. Why? Partly because they have been told over and over not to panic, not to sell, to stay the course, and partly because they just do not know what to do. They are paralyzed. But here's the thing I want you to understand. Not selling, staying invested, that is generally the right advice for someone who has time. If you are 40, if you are 50, even if you are 55 and you have got another 10 or 15 years before you need this money, then yes, you should stay invested. You should ignore the noise. History says the market will recover. It always has. But if you are 68, if you retired 2 years ago, if you are taking 4 or 5% out every year to pay your bills, then staying fully invested in a falling market is not necessarily the right answer because you are compounding the damage. You are selling shares at depressed prices to fund your living expenses, and those shares will not be there to participate in the recovery. Vanguard did research on this, on what they call sequence of return risk, and they found that retirees who experience a major bear market in their first few years of retirement are 31% more likely to outlive their wealth compared to retirees who experience the same bear market later in retirement. 31%. That is not a small difference. That is the difference between security and destitution. And the impacts are not just about running out of money. These retirees also had 11% lower income streams throughout retirement and left 37% smaller bequests when they died. In other words, they lived worse and left less, all because of bad timing. So when people say, do not worry, it always comes back. They are missing the point. Yes, the market comes back, but you might be out of money before the recovery happens. Or you might have to cut your standard of living so much that the recovery does not matter anymore. You are already eating cat food. You are already selling the house. The fact that the S&P is back to new highs 10 years later does not help you if you went broke in year 6. That is what people are dealing with right now. That is the fear. And it is not irrational. It is not panic. It is math. Now let us talk about how people actually respond to this kind of stress. Because understanding the psychology is just as important as understanding the math. Markets are made of people, and people are not perfectly rational, especially when they are scared. The conventional wisdom, the advice you hear everywhere, is do not panic, do not sell, stay the course. The market always comes back. And statistically, that is true. If you look at any 20-year period in American stock market history, the market has always been higher at the end than at the beginning. Always. Even if you bought at the peak in 1929, even if you bought at the peak in 2000, if you held for 20 years, you came out ahead. So the advice is not wrong. For most people, for most situations, staying invested is the right move. But, and this is critical, that advice assumes you have 20 years. It assumes you do not need the money. It assumes you can wait out the cycle. Retirees do not have that luxury They might have 20 years to live, sure, but they do not have 20 years before they need to spend the money. They need it now, they need it next month, they need it next year. So telling them to just hold on and wait for the recovery is not always realistic. It is like telling someone who is drowning to be patient because the tide will come in eventually. Well, they might drown before the tide comes in, and yet most retirees do stay invested. Fidelity reported that only about 5.5% of 401k participants made changes to their portfolios during the second quarter volatility. That means 94.5% did nothing. They did not sell. They did not rebalance. They just held on. Now, is that discipline or is that paralysis? Hard to say. Some of them, I'm sure, are following the advice. They are being rational. They understand that selling at the bottom is a mistake. They have read the studies. They know that market timing does not work for most people. So they are gritting their teeth and holding on. And if they have enough cash reserves, if they have enough bonds, if their withdrawal rate is conservative enough, they will probably be okay. But some of them, I suspect, are just frozen. They do not know what to do. They are terrified of making the wrong move. So they make no move at all. And sometimes that works out, but sometimes it does not. Because here is the dirty secret about staying the course. It only works if you actually stay the course. If you hold through the entire downturn and the entire recovery. But a lot of people, they hold and hold and hold, and then right when things look the darkest, right when the headlines are the worst, right when their account is down 30 or 40%, they break. They sell. They go to cash. And they do it at exactly the wrong time. And then what happens? The market bottoms. It starts to recover. And they are sitting in cash, earning nothing, watching the market go back up without them. And now they are faced with another impossible decision. Do I get back in? Do I wait? And usually they wait. They wait until they feel safe again. They wait until the market is back near all-time highs. And then they buy back in at much higher prices than they sold at. They have locked in their losses and missed the recovery. It is the worst of both worlds. This is why the industry pushes automatic investing in target date funds and just staying invested no matter what. Because they know that individual investors, left to their own devices, will do the wrong thing at the wrong time. They will buy high and sell low. They will panic. They will make emotional decisions that destroy their wealth. And that advice is good for most people most of the time, but it is not universally applicable. It does not account for sequence of returns risk. It does not account for the fact that retirees are in a fundamentally different situation than accumulators. Some advisors are now recommending what they call dynamic withdrawal strategies. The idea is that instead of withdrawing the same amount every year, regardless of market conditions, you adjust your withdrawals based on how your portfolio is doing. If the market is up, you take a little more. If the market is down, you tighten your belt and take less. This gives your portfolio room to recover without forcing you to sell at the bottom. Another strategy is the bucket approach. You divide your portfolio into 3 buckets. The first bucket is cash and short-term bonds, enough to cover 1 to 3 years of living expenses. The second bucket is intermediate bonds and dividend-paying stocks for income 5 to 10 years out. The third bucket is growth stocks for the long term. The idea is that you spend from the first bucket and you refill it from the other buckets when the market is up. But when the market is down, you just let the first bucket run down and you do not touch the growth bucket at all. You give it time to recover. This way, you are never forced to sell stocks in a bear market. Now, these strategies make sense to me. They recognize the reality of retirement. They give you flexibility. They protect you from the worst case scenario. But here is the problem. Most people do not have these strategies in place. Most people are in target date funds that automatically rebalance and do not account for sequence risk. Most people are just hoping that the 4% rule works out. And for some of them, it will. But for others, for the ones who retired in early 2025 at peak valuations, for the ones who are taking distributions right now while the market is volatile, for the ones who do not have a big cash cushion, well, they are playing a dangerous game. And they might not even know it. Now let us step back and think about what all of this means, not just for individual retirees, but for the system, for the way we have structured retirement in this country. Because I think there are some serious questions we need to be asking. First, the obvious one, is the 401k system, as currently designed, actually adequate for most people? And I think the answer, honestly, is no, it is not. It was never supposed to be the primary retirement vehicle. When Congress created 401ks back in 1978, they were meant to be a supplement to pensions, not a replacement. But over the last 40 years, companies figured out that it was a lot cheaper to match a few percent of salary into a 401k than to fund a defined benefit pension plan. So pensions disappeared and 401ks became the default. And that shift, that change from defined benefit to defined contribution, it transferred all of the risk from the employer to the employee. With a pension, the company promises you a certain amount every month for the rest of your life. If the market crashes, that is the company's problem. They have to figure it out. But with a 401k, you get whatever's in the account when you retire. If the market crashes the day before you retire, well, that is your problem. Now, I am not saying we should go back to pensions. Most companies cannot afford them anymore. And there were problems with pensions too. Underfunded plans, companies going bankrupt and leaving retirees with nothing, the Pension Benefit Guaranty Corporation trying to pick up the pieces. It was not perfect, but we should at least be honest about what we have now. We have a system that works great. If you retire at the right time, if the market is up, if you saved enough, if you did not have any major health expenses or family emergencies, if you did not get divorced, if you did not lose your job in your 50s and have to spend down your savings before you could collect Social Security. If all of those things go right, the system works. But for a lot of people, a lot of things go wrong. And the system has no shock absorbers, no margin for error. Then there is the question of required minimum distributions. Why, in the middle of a bear market, are we forcing 73-year-olds to sell stocks and realize losses just so the IRS can collect tax revenue? I understand the logic. The government gave you a tax break when you contributed to the 401k. They want their money eventually. Fine. But does it have to be on a rigid schedule regardless of market conditions? There have been proposals over the years to suspend required minimum distributions during market crashes to give retirees some breathing room to let the portfolios recover before forcing sales. And I think that makes sense. It is a simple change that could make a big difference for people who are right on the edge. But Congress has not done it, except briefly during COVID. And so every April, every year, millions of retirees have to take their RMDs, whether they need the money or not, whether the market is up or down. Now, on the individual level, what should people do? What is the right answer here? And I will tell you, it depends on your situation. There is no one size fits all. If you are still working, if you are 5 or 10 years away from retirement, the answer is relatively straightforward. Keep saving, build up a cash cushion. Do not retire at the peak of a market cycle if you can help it. And if the market does crash before you retire, well, that might actually be a good thing. You will be buying shares cheap in your final years of accumulation. If you are already retired, if you are taking distributions, the answer is more complicated. You need to look at your withdrawal rate. If you are taking out more than 4% a year, especially in this valuation environment, you are probably taking too much risk. You might need to cut back. And I know that is hard. I know it means sacrificing. But running out of money at 85 is worse. You need to look at your asset allocation. If you are 100% stocks at age 70, that is too aggressive. You need some bonds. You need some cash. Not because bonds are a great investment right now. They are not. But because you need stability. You need something that is not going to drop 30% when the market crashes. And you need to think about the bucket strategy I mentioned earlier. Keep 1 to 3 years of living expenses in cash or very short-term bonds. That way, if the market drops, you are not forced to sell. You can live off the cash and let the stock portion of your portfolio recover. Then, when the market is up, you refill the cash bucket. It is simple. It is boring, but it works. Some advisors are recommending 18 to 24 months of expenses in cash. Some say 2 to 3 years. The exact number does not matter as much as the principle. You need a buffer. You need to not be forced to sell stocks when they are down. And then there is the moral dimension, because this is not just about money. It is about dignity. It is about the promise we made, or we thought we made, to people who worked their whole lives. You do the right things. You save. You contribute. You pay your taxes. You follow the rules. And in exchange, you get to retire with some security. You get to live out your final years without fear. But that promise is breaking down. And it is breaking down not because people are lazy or irresponsible, but because the system is fragile. It is fragile because it depends on market timing. It is fragile because it depends on valuations being reasonable. It is fragile because it has no safety net. And when I see retirees panicking, when I see people in their 70s talking about going back to work, when I see couples who saved for 40 years now rationing their groceries, I think this is not right. This is not what we should accept as normal. This is not the mark of a civilized society. I do not have all the answers. I am not a politician. I am not a policy expert. But I know this: we can do better. We can design a system that does not depend on retirees getting lucky with their retirement date. We can create more stability, more options, more flexibility. And we should, because the people who are hurting right now, they did everything we asked them to do, and they deserve better. So let me bring this back to earth. Let me tell you what I think you should actually do if you are in or near retirement right now. First, do not panic. I know that sounds trite. I know it is easier said than done. But panic selling is the worst thing you can do. If you sell everything and go to cash after the market has already dropped 20%, you have locked in your losses. You have guaranteed that you will not participate in the recovery. And the recovery will come. It always has. The question is not whether the market will recover. The question is whether you can afford to wait for it. So before you do anything drastic, before you sell everything, take a breath. Look at your situation. Really look at it. How much cash do you have? How much do you need to live on for the next year? The next 2 years? If you have enough cash or short-term bonds to cover 1 to 2 years of expenses, then you do not need to sell stocks right now. You can wait. You can let the market do what it is going to do, and you can live off the cash in the meantime. If you do not have that cash cushion, if you are relying on selling stocks every month to pay your bills, then you need to build one. And yes, that might mean selling some stocks now, even though they are down. But better to sell a little bit now to create a buffer than to be forced to sell a lot more later if the market drops further. The goal is to give yourself time, to give your portfolio room to recover without forcing sales at the bottom. Most experts are saying 12 to 24 months of expenses in cash or cash equivalents. Some say up to 3 years. I lean toward the higher end. Cash is cheap insurance right now. Yes, it earns almost nothing, but it buys you peace of mind, and it protects you from the worst case scenario, which is being forced to liquidate stocks at a 30 or 40% loss just to keep the lights on. Second, look at your withdrawal rate. If you are taking out more than 4% a year, you are in the danger zone. And if you retired at peak valuations, if you retired in 2024 or early 2025, you probably need to be even more conservative, maybe 3%, maybe 3.5%. I know that means cutting back. I know that means sacrificing. But you have to make the math work. You cannot spend money you do not have. And consider making your withdrawals flexible. In good years, when the market is up, take a little more, enjoy yourself. In bad years, when the market is down, tighten your belt. Cut discretionary spending. Do not take that vacation. Do not buy the new car. Give your portfolio a chance to heal. The Vanguard research I mentioned earlier showed that retirees who used a dynamic spending strategy, who adjusted their withdrawals based on market performance, were far less likely to run out of money than those who took the same amount every year, regardless of what the market did. Third, if you have not retired yet, if you are thinking about retiring in the next year or two, think very carefully about the timing. I am not saying do not retire, but I am saying be aware of the risk. Be aware that you are retiring into an expensive market with below average expected returns. If you can work another year or two, if you can delay Social Security and let it grow, if you can give yourself a bigger cushion, that might be worth considering. And if you absolutely have to retire now, if you have no choice, then at the very least, make sure your asset allocation is appropriate. You should not be 100% stocks at age 65. You need bonds. You need cash. You need stability. The old rule was your age in bonds. So if you are 65% bonds, 35% stocks, that is probably too conservative for most people, but the principle is right. You need ballast. You need something that is not going to crash when stocks crash. Bill Benjamin, the guy who came up with the 4% rule, he recommends 50 to 55% stocks for retirees, with the rest in bonds and cash. That sounds about right to me for most people. Maybe a little more stocks if you are young and healthy and have other sources of income. Maybe a little less if you are older or if you are worried about volatility. Fourth, and this is important, do not forget about required minimum distributions. If you are over 73, you have to take them, but you do not have to spend them. If you do not need the money, if you have other sources of income, take the distribution, pay the tax, and reinvest it in a taxable account. Do not let it sit in cash earning nothing unless that is part of your cash buffer strategy. The point is, just because the government forces you to take the money out of your retirement account does not mean you have to blow it on a vacation or a new car. Treat it like the long-term money it is. Fifth, focus on what you can control. You cannot control the market. You cannot control interest rates. You cannot control whether we have a recession or a bull market or a bear market. But you can control your spending. You can control your withdrawal rate. You can control your asset allocation. You can control how much risk you take. So focus on those things. Make a plan. Stick to the plan. Adjust the plan when circumstances change, but do not abandon the plan just because you are scared. And finally, if you are overwhelmed, if you do not know what to do, talk to someone, a financial advisor, a CPA, someone who can look at your specific situation and give you specific advice. I cannot tell you what to do. I do not know your situation. But I can tell you that doing nothing or doing something rash out of panic, those are usually the wrong answers. There is almost always a middle path, a way to protect yourself without giving up on your goals. You know, I have been investing for more than 60 years. I have seen a lot of markets, bull markets, bear markets, crashes, recoveries, bubbles, panics. And the one thing I have learned is that the market is going to do what it is going to do. You cannot control it. You cannot outsmart it, but you can prepare for it. You can position yourself so that when bad things happen, and they will, you are not destroyed. You survive, you endure, and eventually you prosper. That is what I have tried to do at Berkshire. That is what I think individuals should try to do. Build a margin of safety. Keep some cash. Do not take unnecessary risks. Do not reach for yield. Do not assume everything will always go up. Be conservative, be patient, be rational, and understand that retirement is not a finish line. It is a long journey. It might be 20 years. It might be 30. You have to make the money last. You have to be smart about it. You have to adapt when conditions change. That is not exciting. It is not glamorous, but it is reality. And reality does not care about your feelings or your plans. It just is what it is. So be prepared, be disciplined, be realistic. And remember, the goal is not to die with the most money. The goal is to not run out of money before you die. Everything else is secondary. Keep that in mind, and you will be okay.